Good morning, everyone. 5 minutes after the hour, so we are going to start until the others join. Perhaps by the time that I'm finished with the preamble, the others would have gotten in. Now, before we get off the ground, our little thought for the day. And you notice I like our beloved Nelson Mandela. And this one, he says, it always seems impossible until it's done. Always seems impossible until it's done. So where were we last time? Remember, we had started looking at the financial accounting cycle. And we said in the financial accounting cycle, we start off with our business activities. And the data relating to these business activities would be captured in what we call source documents. Having gotten our data from these source documents, the next thing that we would do is to make a note of them in the formal accounting system. In the way we record these transactions in our journals, or we could say we journalize the transactions. Now remember that we use debits and credits. Remember that the rule I passed on to you. Just say to yourself, first of all, what accounts would be impacted by this transaction? Having identified the accounts, we say to ourselves, which account is receiving and which account is giving? And the little rule is the account receiving is going to be debited and the giving account is going to be credited. Remember, that's the little rule that we say. Now, after we make a note of those transactions, remember we spoke about the use of subsidiary journals. Remember we said that if a business is dealing with hundreds, thousands of transactions, then they will operate what we call subsidiary journals. And remember that we said each subsidiary journal speaks to a specific. So we said the sales journal would relate to credit sales or sales on account. So once you see a name in the sales journal, you know that that is the name of a customer, somebody whom you sold goods to on account, somebody who owes you. Purchases journal would relate to somebody who you owe. One of your creditors or one of your suppliers. And I said to us, any transaction that can't go in a subsidiary journal, we would have to reflect these in the general journal. Now, can anybody remind me what I said was unique to this general journal? What was unique to this general journal? Anybody to the rescue? What was unique to this general journal? Let me see. A note. It has a description. It has a description. What we call that description again?
A narration.
A narration. A narration. Oren, get my contact number from the rep and get in touch with me. All right, and I'll deal with you one-on-one. All right. It's called a narration, and it's just a little note that is explaining what was actually done. Now, after we journalize our transactions, The next thing that we say we would do is to post these transactions in what we call ledgers. And as I said to us, the ledger is the action book, because that is where we are going to be doing up our T accounts. The action area, as we saw, remember the first week we spoke about that action area. Now, after we are finished doing up our T accounts, the next phase of the cycle says that we are to extract an unadjusted trial balance. Now, why are we going to be doing that trial balance? Remember, we were doing debits and credits. So mathematically, if every debit had a corresponding credit, then when we finish up, then total debits now must be equal to total credits. It should be. Now, before we could do that trial balance, we had to balance off the accounts to come up with those balances on the individual accounts. And then the next phase of the cycle, we said that we would do adjustments, because we said that there could have been transactions that took place during the accounting period that were not captured in our journals and ledgers. So we need to bring them in. After we make those adjustments, we come up with a new trial balance that we call now an adjusted trial balance. And then we would use that adjusted trial balance now to come up with our financial statements, because remember that those are what we are aiming for, the financial statements. They are the end result of us going through that cycle. And we spoke about those final statements: the income statement, the statement of owner's equity, the balance sheet, the statement of cash flows. So last week now we left off where we actually started doing the cycle. And I said to you, initially we're going to short circuit the cycle. So what we do? We journalize, we posted. We were now on to doing up our unadjusted trial balance. But we said before we could do that, we have to balance the accounts. We're at balancing our accounts. And I asked you to finish up those balancing. So let's see what we had done up to that point. We had balanced our cash account. Yes, cash is an asset account. And we saw that our cash account has a debit balance of 7,007. Said to us who are doing accounts for the first time, the balance is going to be on the side that has the bigger amount. The balance would be on the side with the bigger amount. So here, notice when we added up the debit side, it has 17,350. The credit side, 9,600. So this balance of 7,750 is on the debit side. We also balanced accounts receivable, another asset account. And we saw that our accounts receivable had a debit balance of 7,490. Yes. We went on to our supplies account. And when we balanced off that account had a debit balance of 640. Land, no transaction affected that account. So the balance remained 24,100. Yes? So that's where we left off. So now, accounts payable. For those who don't remember how we balanced off, remember what we did. We totaled the debit side, we totaled the credit side, and we see which one is bigger. In this case, the credit side is bigger. When we added up, the bigger figure was 6,120. So in balancing off, remember the little thing that we did? There is a balance. We find the difference between 6,120 and 5,4. And that is 720. Remember, I told you the balance is on the side with the bigger amount. So in essence, we are saying accounts payable has a credit balance. And remember, guys, accounts payable is a liability account. And we learned that liability accounts normally carry a credit balance. So accounts payable, 720 on the credit. Yes? Let's look at capital. Now notice here, capital, guys. Let me just show you a little crude way you're going to do things. Because look here, you don't have to, you're not going to be asked in the exam to do any balance CD and balance BD to work out these little T accounts. We're not going to ask you to do them, but there are times when you have to do them in your little rough work to come up with the answer for the question. Your T accounts, they will never fail you. So like now, we look at this one. We only have items on the credit side. So all you have to do, guys, is total up. When we total up that side, it's the credit side only that has information. So clearly, this is going to be a credit balance. So our capital account has a credit balance of 37,360. I could have said balance CD on the debit side, 37,360, and then balance BD. But the important thing is that we know it's a credit balance of 37,360. Now, let us pause for a moment. Look a little at this capital account. What you remember about that 12,000 and that 1,700? Those two amounts, what were they again?
They were investments made by the owner.
They were investments. Beautiful, my darling. They were investments by the owner. Additional investment. So remember that the 23,660 was opening balance, and that total there, the 12 plus the 17, was additional investment. What's the balance on the withdrawal? Notice this one. An entry on the debit side. The credit side is really 0. So the bigger side is the debit side. So withdrawal has a debit balance of 24. So guys, please remember, when we come to this statement of owner's equity, remember that these two are going to be brought in as additional investment. So make note of that on your T account. So when we get there, you remember, in the statement of owner's equity, we're going to have the beginning capital, 23,660. Then we're going to add in the additional investment of 13,700. I remember we're going to take out the drawings. Yes, but when we get there, I'll remind you about that. So that's capital, that's withdrawal. Let's move along. What was the next account that we had? The next account that we had was our service revenue. What the theory says, revenue accounts carry normally a credit balance. Beautiful. So our service revenue account, guys, has a credit balance of 6,100. Coming down in balancing of accounts. I hope you have been getting them correct. Our expenses. We know expense accounts normally carry debit balances. Beautiful. So our office rent account, a debit balance of 1,2. Advertising expense, a debit balance of 600. All right. Now, having balanced all our accounts, it is time for us now to extract our unadjusted trial balance. Now, remember I said to us that we did our debits and credits, and every debit had a corresponding credit. So what is this trial balance all about? For those doing accounts for the first time, let's peek through it a little bit. What is this trial balance? Now, firstly, guys, the trial balance is something that we put together internally. In other words, outsiders not supposed to get their hands on our trial balance. They must get what is the end result of the accounting process. So it's an internal document. But what really does this TB contain? Because we abbreviate it TB. It is simply, guys, a listing of all the accounts with their related balances. You see why we have to balance off the accounts? Because we want those balances to put them together in this trial balance. So the assets, the liabilities, the owner's equity. Remember owner's equity? We have beginning capital. We have additional investment. We have revenues, we have expenses, we have drawings. Yes. So we're going to list all of those accounts. And remember, we spoke about the chart of accounts last week. Yes. So we're going to list all of those accounts and their balances. Now, after we do that, why do we need this trial balance? The TB serves two purposes. The first one is a mathematical one. We want to check upon what we call the arithmetical accuracy of the postings that were made. That is, whether our total debits equal to our total credits. Now notice, guys, I said to you, we are checking the arithmetic. Because look here, you know, we could get our trial balance to balance, you know, and we still made errors, as we will see later in this session. And if you remember, after we do our trial balance, remember the next phase that we went on to in the accounting cycle will be to prepare the final statements, because we say we are short-circuiting the system. So the next function is that it helps us to prepare the final accounts. So guys, we are going to be doing all of that in today's session, all of that. So starting with our trial balance, let's take those balances from those T accounts. And remember, in the chart of accounts, assets, liabilities, owner's equity, revenues, expenses. That's the order in which we go. All right? So let's have a go at it. So, Grace and Architecture, trial balance at May 31. So we're going to list all the accounts. So firstly, we're going to start with cash. And cash has a balance of 7,750. Yes. Next, we pick up our accounts receivable. And accounts receivable has a debit balance of 7,490. Next, we pick up our supplies account. And supplies has a debit balance of 640. Next asset account is land. And land has a debit balance of 24,1. Now, before I go any further, what did we say about our asset accounts again? How do we normally list them? In order of?
Liquidity.
Liquidity. Beautiful. In order of liquidity. So we are seeing here, guys, cash is the most liquid. Land, the least liquid. Cash is our most liquid, and land is our least liquid. Yes? So those are our assets. Next, liabilities. The liability account that we have here in this question is accounts payable, and it has a credit balance of 720. No, it was just picking them up as they are from those T accounts. Next, now we go to our capital account. Yes, so B Grayson Capital, a credit balance of 37,360. Remember that that is made up of the beginning capital plus the additional investment. Next, we have Grayson withdrawals with a debit balance of 24. Next, now we are on to revenue. Our service revenue account has a credit balance of 61. Then we have our office rent expense, a debit balance of 12, and advertising expense with a debit balance of 600. So now, guys, is the acid test. Let us now total our debit column and see if it agrees with the total on the credit column. Let's go, guys. When you add up the debit column, what are you getting?
44,180.
44,180. And when we add up our credit column, what do we get?
44,180.
The same 44,180.
Miss?
So it seems then, guys, that our arithmetic is on point. Total debits equal total credits. But remember I said to you, the trial balance is not foolproof. Longbridge, I see you have your hand raised. Go ahead with your question. Take the microphone.
Miss, I was saying, I'm kind of confused. Debit is supposed to be what you receive, like your assets, right, Miss?
Like assets, yes, like assets carry debit balance, yes.
So why is expenses on the debit? Isn't that something that you have to pay? Shouldn't it be on the credit?
But why do you incur expenses? Were you at the other classes?
Yes, Miss, although my laptop got turned off. In the
Okay, not a problem. Why do we pay expenses?
to pay for our assets.
Expenses here. So supposing you're working with an organization, why the organization paying? Isn't the organization benefiting from the service that you're provided for them?
Yes, miss.
So when they pay you out of their cash, because we're doing the organization's book. So that rent, that advertising, or that salary that I'm using, now salary receiving out of the company's cash.
A salary receipt.
You have to look at salary. Salary expense, that's an account called salary expense. So let me go back to an asset. Let me see if I can take you back a little bit. When you buy assets, because I'm using what you gave me, you say you get assets. When you buy assets, why you buy assets? Why did we say we purchase assets? Why did business purchase assets?
You purchase it to...
Isn't it to help you to earn your income?
Yes.
Beautiful. When, so the business is benefiting from those assets. When the company pays you a salary, isn't the company or the business benefiting from your service that they are paying you for?
Yes, miss.
Yes, miss.
Yes. So the business benefits from assets. The business should be benefiting from the expenses that they incurred as well. So we say expenses like assets carry debit balances. Your business get the benefit.
But if revenue is well, it's revenue doesn't necessarily have to be a profit, it can be a loss. But the revenue that the business gets, why is it under credit then? Shouldn't it also be under debit?
You remember the type of account that we said revenue was?
What said, miss?
What type of account did we say that revenue? You did accounts before?
No, miss.
Okay. What type of account did we say that revenue is? Remember, it's a process we're going through, you know. We're going through a process. And you haven't had any tutorials yet since the tutorial started.
Yes, I went to one.
You went to one. Remember what revenue is. In this organization, it's a service organization. So when the organization provides this service, remember we said every business event affects at least two accounts. The one receiving is debited and the giving one is credited. We're not even going to go back into no asset liability, owner's equity. We're not going to use on it. We're just going to keep it that way. What is receiving is debited, what is given is credited.
Okay.
So when the organization provides a service to earn the revenue, remember the service is either going to be provided and the business gets cash up front, or when the business provides the service, the people owe you. Not true?
Yes, miss.
When you get the cash up front, isn't cash receiving from the service provided? So when we were recording that, didn't we debit cash and we credited the service revenue?
No, miss, you're talking about the income statement, miss.
We not reached the income statement yet. We're doing the double entry because before you can go to income statement, you have to do the double entries. Remember, it's a process we're going through, you know, my darling. Remember, it's a process. Remember, we said that when we start Is a cycle we're going through, you know. That's why we go through the theory first. It's a cycle we're going through. So we get the data related to the transactions. And I'm using the one now where you provide service and earn the revenue. Because remember, the owner invests, yes, as Hal said, is saying, revenues cause the owner's equity to increase. Remember, we went through all of that, you know. You invest as the owner to earn on what you have invested. So I'm saying to you, when you get the cash, you would have debited the cash account and you credited the service revenue. When the people owe us meaning the business, remember we call it a receivable. So what we did at that time, we debited accounts receivable and we credited the revenue. So we not reached the income statement yet. It's there, so we're heading now. We have to do all of that and get all of those out of the way before we can think about income statement. Eh?
All right, Miss.
No, that all right don't sound too like you're too confident.
No,
but I will have to deal with you one-on-one.
Okay.
All right, my darling?
All right.
You know my digits, so you know how to get in touch with me. All right?
All right.
And remember, guys, tutorials are there. Things that are a little bit cloudy for you, when you go to your tutorials, write down your questions and ask. Write down your questions and ask. So this is our trial balance. So we are seeing that the arithmetic is okay. Every debit had a corresponding credit. So says the arithmetic. Now remember, the next function of the trial balance is to assist us in preparing our final statements. Remember the statements we are going to prepare, guys. Our income statement. So talk to me now, my baby, who was just talking to me earlier on. In the income statement is what and what must go in the income statement?
Revenue and expenses.
Revenues and expenses. The revenues and expenses go to the income statement. See, I highlight them for you there in the rectangle. Now, after we prepare the income statement, what next we're going to prepare? Now, this statement of owner's equity. In that statement of owner's equity, we know that it is the capital, the drawings, and what come from the income statement. Not true? So those two going to go to the statement of owner's equity. And after we do the statement of owner's equity, the next thing for us to do is our balance sheet. So those in green, going to the balance sheet. Yes?
Yes, Miss.
All right. And based on what we are seeing here before, let us look at the balance sheet a little bit. Remember, you told me that the assets are listed in order of liquidity. So, and remember that our assets can either be current or non-current. So our current assets would be like our, help me out here. Of these assets, which of them would you put as current assets?
Cash, account receivable, supply.
Cash, account receivable, and supplies. Beautiful. And the non-current asset would be land. Yes? And then our only liability that we have in this question is accounts payable. And that would be a current liability. All right, guys? So let us see if we can put together our statements. Pay attention to the headings on these statements. So our income statement first. Yes? So it's Grayson Architecture income statement. Notice, guys, for period ended, because we are looking back. So we start with our revenue. And the revenue in this question is service revenue of 6.1. Then out of this revenue, we are going to take our operating expenses. What are the operating expenses that we have in this question? We have office rent of 1.2. We have advertising expense of 600. So notice, guys, our total expenses is 1.8. So the theory says the difference between revenue and expenses is going to be our net income or our net loss. In this case, since revenues exceed expenses, we say we have a net income of 4,300. So our net income is 4,300. Yes?
Yes, miss.
Now, after we prepare our income statement, the next statement that we are going to move to is our statement of owner's equity. The heading, guys, basically is the same. The only difference, instead of saying income statement, it will say statement of owner's equity. So here, Grayson Architecture, statement of owner's equity for period ended May 31. Now, what did Grayson begin with? Now, remember, guys, I said to you, when we are doing up the formal statements, we're not going to write no word beginning. We're going to use dates. If you look back at the question, the open balances were given for the 1st of May. So this is how you're going to write it. B. Grayson Capital, 1st of May, 20x7 was 23,660. Then to this, we are going to add the additional investment of 13,700. The net income from our income statement feeds into this statement for 3. So 13,700 plus 4,300 gives us a subtotal of 18,000. We add that to our beginning capital, and that takes us to a total of 41,660. Yes? Then out of this 41,660 now, we are going to take the drawings. So less B. Grayson withdrawal of 2,400. And this now takes us to Grayson's capital at the end of May. So as we started, so do we end. Only thing that changes is the date. So B. Grayson Capital, notice the date, at the 31st of May, 20x7 is 39,260. Guys, if you go back to when we did the crude accounting, if you go back to when we did Grayson first, and you look back at the capital column, if you remember, this is what we have there, you know, 39,260. Look back and see. Now remember, guys, what did we say? The financial statements speak to the performance and the financial position of the business. And I said to us that the income statement and the statement of owner's equity, those two statements speak to performance. Yes? The balance sheet and the statement of cash flows, those are position statements. So we have prepared. Yes, Nunez?
Mister, can you repeat what you said, please?
Yes, I'm saying to us that the set of financials, the full set of financials that IAS 1 referred to, they are speaking to the performance as well as the financial position of the business. Which of the statements speak to the performance? The income statement and the statement of owner's equity. The ones that speak to position are the balance sheet and the statement of cash flow. So if you notice the headings for the income statement and the statement of owner's equity, say for period ended. They say for period ended. So now, guys, we are moving over to our balance sheet. Remember, our balance sheet reflects the accounting equation. And I said to you that it can be shown or prepared in the account format, that's a T format, or we can do it in the report format. For the benefit of those doing accounts for the first time, we are going to use the T format today. Yes, Lawrence, go right ahead.
Miss, can you go over this one more time, please?
Which of them?
Just the table.
The statement of owner's equity.
Yes, Miss. Can you just go over it one more time, please?
All right. If you look, while I'm talking, look at the capital account. You remember the capital account opened with a balance of 23,660.
Yes, Miss.
So see there? All right. Then I showed you where the 12,000 and the 1,700 added up to 13,700. That was additional investment by the owner. So here is that 13,700. Yes? You see that?
Yes, Miss. Yes, Miss. Yes, Miss.
Then now the net income of 4,300. This is coming from the income statement.
Okay.
So when we add that 4,300 to that 13,700, we get a subtotal of 18,000.
Oh, okay.
Yes. So we add that now to the 23,660. It takes us to 41,660. And then now we take out the withdrawals or the drawing.
Yes, Miss. I saw where I got confused. I didn't realize because I went to the bathroom, so I didn't get to see when you guys.
Okay, my darling, understood.
No, I'm following. Thank you.
Okay, doke. All righty. So guys, here is our statement of owner's equity, which is now going to feed into our balance sheet. And as I said to you, for the benefit of those doing accounts for the first time, I'm just doing this one in the T format. But remember, by the time of your assessment, we are going to be doing it in the report format. And by the way, as I mentioned assessment, guys, I see where you would have been under a bit of pressure. in terms of getting to that midterm assessment, because our course is a big course. And we were asked to make sure that we do the exam before the 13th of October. I thought that that was too much for you. And so I begged for us to be facilitated for a later date. The reason being, for those, most of you are at the university for the first time, we have what we call a tent where we do the exams. And that tent can hold everybody. But the tent is not going to be available from the 13th. So they were trying to get us to do everything by the 12th, all the big courses. So Mr. Tai graciously consented to have us do our assessment at a later date. But the only thing is that we'll have to use several venues. Not a problem if it means myself and my other two assistants and some of my tutors help us to man the different centers. So your assessment, we have asked that it be placed on the very last day, because I want to make sure everybody is prepared. So your assessment as it is going to be on the 21st of October, the last day of the assessment period. All right? Make your plans from now, guys. I know some of you work, make your plans from now. All right? When the timetable is out, you'll see the time of day that it's going to be. I'd asked for 1 o'clock. I don't know how it will be yet. I'd asked for 9 initially, but I think that time was already taken. All right, but we'll revisit that. So on now, guys, to our balance sheet. So remember I said to you the balance sheet is a position statement? Yes. So it is Grayson Architecture balance sheet as at, or if you just say at, no problem. Notice how it is different from the other statements, you know, my first time accountant. For the income statement, it's for the period ended. For the statement of owner's equity, period ended, performance for the period. Balance sheet is at a point in time. Remember, the balance sheet reflects the accounting equation. So our assets will be on one side, liabilities and owner's equity on the other side. So here we go, assets. Let us list our assets just as we have them there in our trial balance. And I'm not even splitting them at this point. I'm just writing them as they are. Cash, 7,750. Accounts receivable, 7,490. Supplies, 640. Land, 24,1. So when we total that side, we get our total assets. And what is that figure, guys? When you total, what do you get? What are we seeing when we total?
It's 39,980.
39,980. Let's go to the other side of the T now. Liabilities. We have only one liability. Remember, I pointed it out to you already. Accounts payable, 720. So now, owner's equity. Our owner's equity, guys, we just go back to the statement of owner's equity, and we're going to pick up the figure from that last line. B. Grayson Capital. And that date, Grayson's capital was 39,260. So when we add together the liabilities of 720 plus the owner's equity, 39,260, we now end up with total liabilities and owner's equity of 39,980. So it is indeed true that assets will be equal to liabilities plus owner's equity. Now, guys, remember that we said that when we these final statements, they are going to be used by persons outside of the entity. And these persons are going to be making decisions about the entity. Should we invest in the business? Should we lend to the business? So look here now. Supposing that Grayson wanted to get a short-term loan from the bank. Listen, you know, he wants to get a short-term loan from the bank. Remember, the bank would need his financial statements. Yes, but because the bank is going to be deciding whether they should lend. Now, as the banker dealing with Grayson, the customer, what would you be most concerned about? Remember, they want a short-term loan.
Miss liabilities.
Just the liabilities. Short-term relates to what?
12 months or less.
12 months. Right you are. So yes, liabilities, my darling, but the ones relating to 12-month period, what you call them?
Current liability.
Current
Current
liabilities.
liabilities. Beautiful. And at the same time, you would also be concerned about the current assets. Not true?
Yes, miss.
Because the man have to go pay the bank back the money. It's short term we're looking at. So look here now. When the outsider is looking at this aspect of the business, we say that they are evaluating the, listen for the word now, solvency. The solvency of the organization. When we talk about the solvency, we are talking about the ability of the business to meet its financial obligations when they become due. So if we're talking about a short-term loan, remember you say you're looking at current aspects. So let me identify my current assets. Aren't these the current assets? Cash, accounts receivable, supplies. So when we total them up, our total current assets, guys, is 15,880. Make note of that figure. Yes? So let's talk a little bit about solvency, and then we are going to work out the things relating to that short-term solvency or the short-term debt paying ability in regards to that short-term loan that you want. You meaning Grayson. So solvency, as I said to you, relates to the ability of the business to meet its financial obligations when they become due. So the one relating to the short term, ST here, guys, is short term debt paying ability. Two things. The first one is what we call the working capital. Remember that? I mentioned this to you already. The working capital of the business. The difference between its current assets and current liabilities. So in this question, our current assets total 15,880. Our current liabilities is 720. So working capital 15,880 minus 720 gives us 15,160. So our current assets exceed our current liabilities by 15,160. Now, guys, we are not going to get into the interpretation of these yet. But when we revisit final accounts in preparation for your midterm and your final assessment, we are going to be looking a little bit deeper at these. The second measure, still dealing with current, is what we call our current ratio. And our current ratio is equal to our current assets divided by our current liabilities. So here, guys, our current assets, 15,880. Our current liabilities, 720. So here we go. So when we divide $15,880 by $720, remember, guys, you cannot get a dollar answer. It is given in terms of times. So here we are saying that our current assets cover our current liabilities over 22 times. Now, without even going into interpretations, you know, see the business looking good. Because if you look at the current assets, the composition of the current assets, you remember that in amongst those current assets, we have cash of 7,750. Our current liability is just 720. So if the people who we owe call upon us to pay them right now, we don't have no problem. With ease, we can pay them. With ease. In fact, maybe I would say to Grayson, maybe you, based on your liabilities, maybe you have too much cash in the business, you know. Maybe you should have tried and do some investment. But then again, I said we're not getting into any interpretation yet. But remember these. Your short-term measures of short-term debt paying ability are your working capital and your current ratio. So these relate to the balance sheet. Let's look back at the income statement now, the information that the income statement provides, and the statement of owner's equity. We tie the two of them together. Now remember that as the owner, you invested in the business to earn on your investment. So it therefore means that as the owner, you will be concerned about whether you're making profits, yes or no. Remember, we said profit is not cash still, you know. But we're going to look at our profitability. So let us now see how we would go about evaluating profitability? So we want to see what happened to what we have invested. Is there an increase on what we have invested? And we will be able to pick that up from what we have in the income statement. Did our revenues exceed our expenses? That's the only way the equity going to step up. Revenue more. So what are some of those measures that we use? In regards to this question, the service organization, the first thing we would look at is what we call the net income percentage. And to get this net income percentage, we simply put our net income over our total revenue. So look back at the income statement. The net income from the income statement is 4,300. Isn't that so? And the total revenue from our income statement is 6,100. So our net income percentage would be 43 divided by 61. And that would be equal to 0.705 or 70.5%. And without even knowing how to interpret it, things would be looking good. Not true? Because your revenue was 6,100, and remember that is only 1/8 out of that was expenses. So it seemed to be doing nicely in terms of net income percentage. Now, the next one that we would use to evaluate our profitability from the owner's perspective is what we call the ROE, R-O-E, return on owner's equity. Now, this row is equal to our net income, notice guys, divided by the average owner's equity. Now, what do they mean by the average owner's equity? Go back to your statement of owner's equity for me. And let me see if I can use it to explain it to you. The average owner's equity is the beginning owner's equity plus the ending owner's equity divided by 2. That's how we get our average owner's equity. So look back at your statement. What is our beginning owner's equity again?
23,000.
23,660. That was the beginning owner's equity. Yes? And our ending owner's equity stood at, what was it? What was our ending?
39,260.
Yes, indeed. And Moya, see you're on it. 39,260. Indeed. So to get that average Freeman, we just need to add the 23,660 and the 39,260 and divide that sum by 2. And what is our average owner's equity then?
31,460.
31,460. My darlings, please remember. So let us substitute our net income. We know is 4,300. Yes? And we divide it by that average owner's equity, which we know is the beginning of 23,660 plus the ending of 39,260 divided by 2. And so our return on owner's equity, based on what we have here, is what you get?
13.6.
13.6 or 13.7%. That's our return on owner's equity. That's our rule. Now remember, we are going to get into the interpretation of those. But for now, we'll just leave it there. But perhaps, perhaps you could reason a minute or two about this return. The net income is 4,300. The average owner's equity is 31,460. When we look at the statement of owner's equity, we saw that the owner had made some additional investment in the business. Now, if I were the accountant advising Grayson, I would have to find out from Grayson what really is his intention for putting in that additional capital in the business. It could be a situation, where perhaps he wants to invest in some additional non-current assets. Maybe it's that he wants to do. But if he doesn't really have a plan to do something like that, I would have said to him, hold on and putting in more in this business. Because the return in my opinion is a bit on the low side, although we would compare this with what obtains in the industry, because perhaps it's what they're doing in the industry. I don't know. But we would have to have a little talk, meaning Grayson and myself, the accountant. We will have to have a little talk. But by the time you're finished this course, you'll be able to have the talk with the person that you're advising as well. All right? So remember those guys. How do we evaluate solvency? How do we evaluate profitability? All right? So we have looked at the statement of owner's equity. We have looked at the balance sheet. So what was the other statement that we said that we need to do up?
The cash flow.
The statement of cash flow. Beautiful. Now, as I said to you before, we're not going to ask you to prepare the statement, the full statement. But you could be given some lovely 3 marks MCQs, which speaks to the different components of the statement of cash flow. Now, remember we said that the statement of cash flow is simply explaining to us what caused the change in cash what caused cash to change? So if we go back to our cash account, and those who have done accounts before, all the statement of cash flow is supposed to speak to us about is what caused cash. Remember at the beginning, cash was 1,720. And at the end, cash is 7,750. So there is a change in cash. In fact, there is an increase in cash. What is that increase in cash? 6,030. So this statement of cash flows, guys, is supposed to explain to us what caused this increase of 6,030 in cash. Now remember, the theory says we're going to examine in this statement where cash came from. And the cash that come in, we call it inflow. And how we use cash, we call that outflow. Now the next thing, remember we said that the statement of cash flows speaks to 3 activities. Help me out here now. What are the 3 activities?
Operating activities.
Operating activities,
Investing, financing.
investing activities, and
Financing.
financing activities. Beautiful. So here what now, guys? We have to go through each of these entries in the cash account and identify whether it is operating, investing, or financing. Let's remind ourselves, operating relate to our core activity. And we said we could really kind of use the income statement to guide us. So if we talk about revenue, what coming from our customers, what we pay out to our suppliers, what we paid out in terms of expenses, like wages and salaries, like rent, like utilities. Investing, remember that relates to property, plant, and equipment mainly. We did buy any, that would be an outflow. We did sell any, that would be an inflow. Investing, did we lend money to anybody? Did we invest in any other business? Yes. Financing. Financing, remember the business is financed by either borrowed money, that is debt, or owner money, that is equity. So for financing activities, did the owner put in any more money in the business? Did the owner take out any money out of the business? Did we get any loans? Did we pay back any principal on those loans? So make we look at it and see. The first one, we're looking at the inflow side first, where cash came from. This 12,000, look back at the transaction. You remember that this 12,000 was money that the owner put in the business? So what kind of activity would that be? Talk to me.
Investing.
That the owner put in the business. Let me see what my chat saying. Moya say financing.
Investors.
Lawrence say financing. What the owner put in the business. Come, I want everybody to be on the same page. Gordon saying financing. What the rest of us say? Financing it is indeed. Yes, indeed. What the owner puts in. You notice I revised the 3 activities with you first before I ask you. The business is financed by owner money or borrowed money. So the owner put in money, it is financing. Take your time. Look at the 1 now. That 1,100. No service we did provide and get it. So what kind of activity would that one be?
Operating activity.
Operating activity. Beautiful. Yes. What about that 750? Wasn't it some money that we collected from our customers? Yes, it's some money we collect from customers. So yes, indeed. Graham is saying it would be operating. Yes, indeed. Yes, Bromfield, it is operating. Yes. What about that 1.7? What was it in relation to? Not the owner did put in some more money in the business?
So it's financing.
Yes, indeed. So it is Jones and Bromfield financing. Make we talk about this 80 now. What did happen with that 80 again? We then buy some supplies for use in our business. And one of our colleagues run out. And we just sell them back some at cost. In other words, we treated it like we use it up. Because we're not in the business of buying and selling supplies. So what type of activity would you say that one is? Let me see if you're thinking. Ah, boy, I think I could catch you.
Miss financing.
Financing? Is debt or equity that?
Yes, I think it's investing because we're not in the business of selling supplies, so it wouldn't be operating. And we're not, and it's not a debt or equity, so it wouldn't
But
be
what you buy
financing.
supplies to do?
To use it.
To use in the business. Remember, is a colleague run out and ask you to sell them a little of yours. So in truth and in fact, you're treating it as though you use it. Notice you just giving it back at cost. So this is the trickiest one. I would have thought. But I see some people were in the chat were on target. Nunes on target, Bromfield on target. It would be operating. You buy supplies to use in your business. It's operating. Make we go over on the outflow side. So you notice all of them have plus beside them because they are inflows. Yes. Make we go over on the other side now. This 5,400, that was a payment that we made to our suppliers. Not true? So what activity would that be? I see everybody on target here in the chat. Beautiful. Operating activity. Yes? What about the 1, 2, and the 600? Those were expenses that we paid. So beautiful, my darlings. Everybody on target. Operating activities. And what about that 2-4? What about that 2-4? That is what the owner took out. And find it related to the owner. Yes, indeed. It has to be financing. Beautiful, my darlings. So you notice the ones on the inflow side with plus cash come in, and the ones on the outflow with minus cash going out. So we're going to put all the operatings together. We don't have any investing in this one. And all the financing together. So let me show you now how we will put it all together. So it's the Grayson Architecture Statement of Cash Flows. And remember, we said, guys, that operating activities are most important. So them going to come first. So, cash received from customers. You see, I make sure I put in brackets, so I get that total. The 1, the 750 plus the 80. Yes, Lawrence?
Yes, can you go back so I can take a picture of the previous slide before we continue to this one? I want to have it in my book.
Okay, my dear, let me go back. There you go, my darling.
Thank you, Miss. 1 sec. Thank you, Miss. Can go ahead.
All righty. So the cash received from customers. Notice that's an inflow. Yes. We have cash paid to suppliers. You notice I have it in brackets there. That's an outflow. We have cash paid for expenses. The 1, 2 plus the 600. Now, guys, when you net it off, you notice that the net figure is going to be an outflow. In other words, we used up more cash than we got in from operating activities. So if there was a multiple choice question that said to you now, what was the net cash used for or provided by operating activities? You would just net off them and say, in this case, it would be net cash used for, because outflow exceeds inflow. you use more than you got. So you'd look for the answer that says 5,270. In this question, the next one, cash flows from investing. I put 0 to hold the space because there is none in this question. So cash flows from financing activities. What were they again? We had some cash coming in from the owner. Additional investment by owner, 13,700. And the owner took out some cash. So notice here, in terms of financing activities, what came in exceeds what went out. So if there was a multiple choice which says, what's the net cash flow used for or provided by financing activities? You would say, look for the answer that says net cash provided by financing activities is 11,300. More money came in from financing than went out. Now remember, guys, when we looked at the cash account, the change in cash was an increase of $6,030. We are now going to add up the net cash used or provided by the different activities. So in this case, 5,270 outflow, 0 plus 11,300 inflow. What do you get as that figure? What do you notice?
6,030.
6,030. Isn't that 6,030 the increase in cash that we saw in the T account? So the theory says that the statement of cash flow explains the change in cash. There it is. The only thing that we have done is to break it out into the different activities. So to top off this statement, all you would do is to take, yes, so 3 hands are raised. You see who they are? Lawrence, you have a hand raised. Nunes, your hand is still up.
Yes, Miss, I was asking if you could repeat that back, please.
Okay, my darling. I'm saying to us guys that when we looked at the T account for cash, we saw that cash at the beginning of the period was 1,720. And cash at the end was 7,750. So there was an increase in cash of 6,030. The statement of cash flows, the purpose of this statement is to explain what it is that caused the change in cash of 6,030. So to explain that change, we have to break it down into the 3 activities. What aspect of this related to operating activities? What aspect relates to investing? what aspect relate to financing? And when we break it out, guys, and we put them back together, the three pieces together, it must come back to what we had in that cash account. That change of 6,030. And we are seeing here that right when we looked at the operating activities, there was a net outflow of 5,270. And for financing activities, net inflow 11,300. So overall, the net effect is an inflow increase of 6,030. Are you seeing that now, Nunes?
Yes, Miss, thank you.
Beautiful. So to wrap it up now, all we simply do is to take that beginning cash balance of 1,720, add it to that change, and it comes right back to the ending cash balance. And that is what they call a statement of cash flows. So remember, guys, we are not going to ask you to prepare the full statement of cash flows. But the fact is, you should be able to look at a list of accounts given, a list of events that they give you, be able to identify which of the activities it would fall under, whether it's an inflow or an outflow. All right? And be able to tell the net amount. So guys, for the rest of the session, we are going to make one other little baby step. If you go back to when we spoke about the trial balance. Henry, could you please make sure that your microphone is in the off position? Henry, do that so I don't have to mute you. All right.
Apologies.
Okay, my darling. Now, remember I said to you guys earlier on that the trial balance serves two main functions. It checks on the arithmetic and it helps us to prepare our final statements. I also said to you that the trial balance is just saying every debit had a credit. Nowhere is it saying that the debit was right and the credit was right. Nor is it saying that you had picked up every debit and every credit. In other words, you picked up all the transactions. So the bottom line, guys, is that the trial balance is not foolproof. It is not infallible. It is capable of errors. It is merely what we call superficial evidence of the arithmetical accuracy of the postings that we made. So it means errors could have been made, but they did not affect the balancing of the trial balance. Now, we could have prepared the trial balance. And when we add up the two columns, They didn't agree. Now, when we have a situation like that, it usually happens because we made some mathematical mistakes. Perhaps we did some incorrect postings. Or perhaps maybe when we were transcribing data, we did it incorrectly. When we're transcribing, we say when we were extracting the data, we did it incorrectly. So the bottom line, guys, we have some errors that wouldn't affect the balancing of the trial balance. And we have some errors that would affect the balancing of the trial balance. Now, errors are usually corrected by way of journal entries. Now talk to me. Which of the journals you think they would use to correct errors? A
General
subsidiary,
journal.
the general journal. And why, my darling, would we use the general journal? Talk to me.
Because every transaction passes through it.
Something a little bit more. What we know, every transaction that we record in the general journal must be
Narrated.
beautiful. Beautiful. Every transaction recorded in the GJ must be followed by this little note explaining what it's all about. Now, I'm sure that some persons thinking you make errors. Now, you couldn't just cross it out. In accounts, we call that the ruling method. It may be used when we're dealing with manual systems, yes. But it's only under certain conditions. If you have made some incorrect journal entries that you haven't yet posted, so you don't put them in the action center yet, you may do crossing out. Or if the journal entry is correct, but when you're going to do the posting, you put it to the wrong account, then you could have do a little crossing out. We call it the ruling method. But you can't just cross out so and leave it. What you think would have to happen? You don't even have to know no accounts to know this. When you cross out something, for it to say you're not trying to commit any fraud,
Have to sign.
it has to be initial. And it cannot be initial by any and anybody. It has to be initial by somebody who is so authorized. So all you would do in that case, strike out the wrong information, write the correct information above the line that you use to strike out, and then the person who is authorized to make that change will affix their signature or initial to that. We have to leave something for the audit trail. So we are now going to speak to those two groupings of errors. Errors which do not affect the balancing of the TB, and errors which do affect the balancing of the TB. Now, if you read your summary notes, or if you have your summary notes, you would see that all you're going to need to do is to write down how to correct the errors. We know already we're going to use journal entry. Now, let me tell you something. If you don't understand the little rule of debit and credit, what to debit, what to credit, you're not going to be able to correct the errors. I'm telling you from now. All right? So errors not affecting the balancing of the TB, 6 of them. The first one, we call it error of omission. Yeah, you don't have to know accounts to do this, to know this. If the transaction was omitted, it means neither did you record nor post that transaction. So it can't affect the balancing of a TD. It is not there. Make we use an example. We purchased a motor car on account from Used Wheels Limited for 450,000. But what? We made no record of the transaction. So the first thing you have to say to yourself, all right, I now need to book this transaction. Let me look at it. Which account will be affected by this transaction?
Non-current.
The motor car, the non-current account motor car, and we bought it from Used Wheels on account. So that means that we owe Used Wheels for it. Ah. So the accounts affected would be motor car and accounts payable, Used Wheels. Which is the receiving account?
The non-current motor car.
The motor car. Are we getting it from Used Wheel? So what the little thing say? The account receiving is debited.
Yeah. Okay.
And the giving account is credited. So to correct this error, we simply debit the motor car account, 450. And we credit accounts payable, Used Wheels Limited, 450. Very simple. Taking our time. Let me go to the second one. The second one is what we call an error of commission. Now, what they say, you make an error of commission when you put the amount in the wrong account of the same class. Wrong account, but the same class. Make we look at the example, make it clearer. Look here now. We sold goods to B-Marks for 23,000. But look at what we did. We debited the account of D-Marks. Now, let's think about it. When we sell goods to the person, clearly, if we have it says we put it in the person's account, it means that the good was sold on account. So we debit the account receiving and we credit giving. So we should have debited B-Marks and credited the revenue account. But what did we do? We've gone and we debit D-Marks. Now look, remember we said it's a wrong account of the same class. B-Marks and D-Marks.
The personal account.
Beautiful. They are both personal accounts. They are both personal accounts. They're in the same class. Natural personal. Part of accounts receivable. Not true. So make we see what we did. Do the little T accounts. And your T's never fail, you guys. See there? Because the revenue account, all right, you know. adjust the wrong person, because look here, maybe what happened, you know, when you see time I go by and B marks again, what happened?
Miss,
But
you're
what-
breaking up, so we're not hearing you.
Yeah. Let me go. I'm saying to you. I'm saying to us, what would have happened is that you made a call to B marks where you see time going by and he's not paying you. And you say, what happened, man? You know who me? You call D marks. And D marks say, no. You say, yes, man. You owe me 23,000. Say, no, man. I don't owe you. So what you do now? You run back to your source document. And when you run back, you say, oh my word, it's not D marks, it's B marks. So we need to take it out of D marks account and put it where it rightfully belongs, in B marks account. To take it out of D marks account, won't I have to credit the account?
Yes, miss.
And the corresponding debit, put it where it belongs, in B marks account. So I would debit B marks and I would credit D marks. So having done that, marks out here, zero out. D marks no awesome. Is B marks. We're going to call B marks. Let's take another error. Error of principle. And accounting students always make this error, where you put the amount in the wrong class of account. You do the debit and credit, but wrong class for one of the debit or one of the credit, whichever. So look at this example. Look at what we bought. We bought a computer for 54,000 to use in the business. So isn't that a non-current asset? Isn't that
Yes,
a
miss.
real account? But look at what you debited. Purchases and credited cash. The credit to cash good to go. You do the debit and credit, trial balance, still balance. So draw your little T accounts. The two accounts we're dealing with here, purchases and computer equipment. Not true. You debited purchases. You should have debited computer equipment. So to correct this error, we would need to credit the purchases account to take it out. And the corresponding debit goes to computer equipment. Let's see if we can take one more before we go to the room. This one, error of original entry. Original entry relates to the source document, not true? So if it's an error of original entry, it simply means that you copy the information wrongly from the source document, and you put that wrong information in all the accounts affected. So look here now. You sold goods on credit to S. Greaves for 5,640. But you entered the amount as 4,640. So I sold goods on credit to S. Greaves. So I would debit accounts receivable S. Greaves, and I would have credited my sales revenue, not true? So when I look at the figures, of 4,640, I put in the two accounts. But it should have been 1,000 more, not true? It should have been 5,640. So somebody tell me, how do I correct this one? Make it nice for the road. How do I correct this one? I'm watching the chat and I'm listening. Debit. What's the receiving account? Come now, man, help me out.
Sales is the receiving account, right?
Robinson, why you put question sign? Greaves is a receiving account. It should be increased. And revenue, the giving should also be increased. Yes. So it therefore means to correct this one, we are going to debit accounts receivable Greaves 1,000, credit sales revenue 1,000. Guys, the summary notes are there. I'm going to ask you to try and go through the others. And when we meet next week, we will pick up at number 5. Also, guys, please print worksheet number 2. Because after we are finished with errors, in the first part of the course, we are going to go to adjustments, which is going to be the big question that you have to do in your midterm. Williams?
If you can repeat the worksheet, which one?
Worksheet number 2.
Okay.
All right. Williams, spend a little time and go over. And if you're still having issues, then we will speak. Corey?
Yes, Miss, good morning. Miss, I remember you giving a date, October 21st earlier. What was it for again, Miss?
Your midterm assessment.
Okay.
The recording is always there, you know, read.
What date is it?
The 21st. Read, the recordings are there. You see, all you have to do is just click on, like when you're coming to the class, and then you simply look for cloud recordings. Click on cloud recordings.
Previous recordings.
Yes, man, and you'll see, you will see all of the recordings there, and you just click on the one that you want. All right? Oh, Jabari. Oh, yes, man, they are there. All of the recordings are there. Just click on the room, click on the Zoom room, And then as you click on it, just look for the thing that says cloud recordings, and you just click on that and you see all the recordings.